Good morning and a very warm welcome to our webinar this morning. Thanks for joining us and welcome back to those of you who've listened to one of our webinars previously. I'm Steve McPhillips, Dentons Technical Sales Director, and part of my role is to provide technical help and support to paraplanners, advisors and my colleagues in Dentons Sales and Marketing team, many of whom are listening in the background, and I'll introduce you to some of them later on in the webinar. Today we're going to metaphorically venture under the bonnet of commercial property within self-invested pensions, that's SIPPs and SSAS, and we'll look at some of the current challenges facing some clients who wish to make this type of investment at the current time. And we'll also look at some potential solutions to meet those challenges. There's a Q&A facility this morning available through Zoom, so please do submit any questions that you have as we run through the webinar. You can submit those anonymously to them, and then we'll look to address those towards the end of the webinar in a live Q&A session for you. And we'll also have a poll towards the end of the webinar as well, so we'd appreciate your help and support in answering a question for us as and when the poll slide comes up towards the end. So I'll disappear from your screens for now, and we'll start to look at the content. We do have some particular learning objectives this morning, which I hope the content will cover off, and as usual, we'll revisit those at the end of the session. Our agenda is set out here, as you can see on the screen, and it's targeted at the self-invested pension market, with particular emphasis on how we can assist you with your SIPP and SSAS clients with commercial property inquiries. And as I said, please do submit any questions through the Q&A facility, and we'll answer these live as time permits at the end of the webinar. To begin with, though, I'll briefly introduce or outline Dentons Pensions to you in case you've not heard from us before. Now, we're a provider of bespoke SIPP and SSAS, and we also offer a lower cost single portfolio SIPP option for platform discretionary fund manager only cases. We've been involved in self-invested pensions for a long time, since 1979, and that's when the ground rules were first set down by the then Inland Revenue about what you could and couldn't do within small self-administered schemes. With a framework then available, Dentons launched a SSAS contract. We've got long-serving members of staff, and I'm pleased to say that we hold more than double the amount needed to meet our capital adequacy requirements of the Financial Conduct Authority. We have over 7,700 SIPPs now. We look after over 1,400 SSASs. And we're also pleased to be able to say that we look after over 3,500 commercial properties, and that makes us commercial property specialists. Now, our SIPP and SSAS numbers may have increased quite significantly since you last heard from us. That's due to organic growth and also 2 acquisitions earlier this year as part of our controlled growth strategy. So that's who we are then. Now then, let's have a look at the subject matter and head under the bonnet. And we're going to start with a look at commercial property in detail, starting with some advantages and disadvantages of holding it in SIPP. And we thought we'd cover this because we know that some advisor firms don't necessarily or haven't necessarily been involved in commercial property purchase through SIPP and SSAS previously. So let's begin by looking at some of the benefits of commercial property being held directly in SIPP and SSAS. Well, one is that the pension scheme is a separate legal entity from the client as an individual or the client's business, as you'll be aware. And assets in the pension scheme sit outside of the member's estate for inheritance tax purposes. The rental income that's received on properties is received into the pension scheme bank account tax-free, free of income tax, and on eventual disposal of the property by the pension scheme, there's no capital gains tax to bear on eventual disposal. Bricks and mortar, commercial property is a tangible asset. That certainly appeals to some clients in my experience over the years. They like the ability to be able to run their business from the premises owned by the pension scheme, or they just like the fact that they're able to drive past the property at some point and see that it sits there as an asset of the pension scheme growing for the retirement. There's often a stable and often increasing income stream from property by the way of rental income. Standard institutional type leases often have an upwards only rent review clause, so the rent can never go down, although it can go up. So a stable and known income stream is another asset or facet of commercial property. And if the vendor of the property is the client's business or the client as an individual, then on disposal of the property to the pension scheme, that will release cash to the client's business or the client as an individual, because they're selling an asset that they own corporately or individually to the pension scheme. That produces cash for the client or their business, which has been an advantage for a number of years, but perhaps more so taken advantage of in the last 16, 17 months or so. Just to compare that with some disadvantages then clearly commercial property can be a single large asset. It can be seen to be illiquid, although interestingly, the FCA class it as a standard asset that is capable of being disposed within 30 days. And of course, if the property did go to auction, for example, then that timescale could possibly be met. In the normal course of events, people would prefer a longer marketing period for a property just to maximise the potential purchase price or the sale value for it. And also, if the client is an individual or the client's company is the vendor of the property, the pension scheme buys it from them or the company. Just bear in mind that there may be CGT or corporation tax implications for that, because if there's a gain on the value of the property at the time it's sold to the pension scheme, then that gain will be subject to capital gains tax in the hands of the individual, or corporation tax if it's the company disposing of the property. But for many clients, the benefits outweigh the disadvantages, making commercial property purchase a popular choice in SIPP and SSAS in our experience. So what types of property can be acquired then? Well, I'll put on the screen here a couple of slides. The list isn't meant to be exhaustive, but these represent some of the types of property that have been accepted by Dentons over the years following our normal due diligence processes. So starting with the straightforward types of properties that come across, offices, industrial units, warehouses, those sorts of things, generally very straightforward because there's usually no residential element to them. So we see a wide range of offices, industrial units and warehouses sit in our SIPP and SSAS books. When we get into the realms of mixed-use properties, for example, shops with residential accommodation upstairs, or public houses or hotels with managers accommodation, that's where things become slightly more involved, because we've got mixed-use residential and commercial elements there. Now, sometimes it is acceptable to hold mixed residential and commercial property within SIPP and SSAS without tax charges applying, but sometimes it's not. And that's part of the due diligence work that we would carry out on any proposed commercial property purchase that you put to us. Just another range of different types of properties that come up again on the screen there. I have a couple of inquiries on the go for vet surgery at the moment, where clients, husband and wife, are vets, and they're looking to have the vet surgery acquired by a couple of SIPPs for them so that they're owned jointly. So there's a whole range of different types of assets that could be bought through a self-invested pension. If you're unsure about the possibility of any type of property being acceptable, just let us know and we'll guide you through the process. But they're all subject to individual asset acceptance by Dentons. And as I said, it's not an exhaustive list. These are just some examples of the properties that we hold across our book over the years. So if a property is going to be acceptable to the provider, thoughts then would naturally turn to how it's going to be funded. So let's have a look at that now then. Now, with an experienced provider, a whole range of options should exist regarding property ownership. The most straightforward of these is where there's enough cash in the SIPP or SSAS to buy the property outright. There's no recourse to external borrowing, there's no other party involved, there's just enough cash in the scheme to meet the client's needs. And we'll look at some of these examples when we come to the client-specific case studies later on. But that's the most straightforward instance. There's cash in the scheme and it's more than enough to purchase the property outright. The next potential option, depending on the provider that you're speaking to, could be a part or joint purchase of property with cash that's held in the pension scheme. Now, that part or joint purchase could be with another SIPP, could be with another SSAS, it could be with the client's company, could be with the client as an individual, could be with any number of people. But here we're talking about the parties joining forces and only using the cash that's held in the pension scheme to make the purchase work. And at the top end of complexity, you could be looking at a situation where there's, excuse me, outright part or joint purchase of the property with cash that's held in the pension scheme. But in addition, the pension scheme then enters into borrowing to help make the purchase work, and the other party may also enter into borrowing as well. So real top-end complexity stuff may not be available to you or to your clients, depending on the provider that you deal with, but there are a wide range of funding options that should be open to your clients, depending on what their specific needs are. Just another word on funding. The VAT position of the property must be clear prior to purchase, and often the VAT status of a property isn't known early enough in the process, but it is crucial that it is known because it's crucial to the overall funding or feasibility of the proposal. And that's because the overall funding of the purchase must cover any VAT on the purchase price, if applicable, plus other associated costs. Now, I say if applicable because sometimes a property may sit in the VAT world, may be opted to tax, but VAT isn't actually payable on the purchase price. Now, we're not VAT experts in any way, and we would always point clients towards a VAT specialist for advice on this, but sometimes VAT isn't payable on the purchase price if what's known as a transfer of a going concern or a TOGC applies. Now, broadly, a TOGC applies where a property is being bought with a sitting tenant in place with a lease, and that tenant is continuing in situ with that lease post-purchase by the pension scheme. So effectively, the business of renting out a property isn't changing from one landlord to another. And if a TOGC applies, although we have to register the pension scheme for VAT in order to claim the TOGC exemption, VAT doesn't need to be paid on the purchase price. And if VAT isn't payable on the purchase price, that means then that the stamp duty or land and buildings transaction tax in Scotland, that means that the LBTT or SDLT liability isn't inflated by the amount of VAT as well. Because if VAT is payable, then the stamp duty or LBTT liability is based on the purchase price plus VAT. And so overall, the funding must cover all of the expenses involved: legal, valuation, advisor, wrapper fees, all those sorts of things. And it's part of what we look at when we're looking at when we're carrying out our due diligence on a commercial property proposal that's put to us. Does the funding stack up? If it doesn't, then we need to ask some questions around that to ensure that it does. Another aspect of funding is that the pension scheme, as I mentioned earlier, may need to enter into some borrowing to make the purchase feasible, make it happen. Now, I'm pleased to say the same rules apply to both SIPP and SSAS when it comes to borrowing. Prior to A-Day in 2006, SIPP and SSAS borrowing rules were very different. And that difference sometimes drove clients to either SIPP or SSAS, depending on the most favourable calculation. So how does that look? Well, in straightforward cases, it's 50% of the net asset value in the SIPP or SSAS is the maximum scheme borrowing. Now, that's straightforward if there's no pre-existing borrowing in place. So let's say there was £100,000 net asset value in the pension scheme. Another £50,000 could be borrowed on top of that, giving a purchase power of 150. That's assuming that all the £100,000 that was already in the scheme sits as cash. So maximum borrowing 50% of the net asset value in the scheme. However, it's not as straightforward as that, because if there's any pre-existing outstanding SIPP or SSAS borrowing, that needs to be taken into account as well. And the maximum borrowing is 50% of the net asset value in the scheme minus any outstanding SIPP or SSAS borrowing. Now, that calculation can be quite complicated, well, not complicated, but can be counterintuitive. So I thought perhaps an example might help to show you how that works in practice. Let's say we have a scheme here with a £500,000 property and £50,000 sitting in cash. There's an outstanding mortgage, though, of £100,000. So the first step of the calculation is to work out the scheme net asset value. Well, the net asset value of the scheme is 550, that's the property plus the cash, minus the outstanding mortgage. So 550 minus 100 gives you a net asset value of £450,000. Now, the next part of the calculation is 50% of the net asset value minus pre-existing borrowing. So 50% of 450,000 is 225. And from that, you've got to take off the existing £100,000 mortgage. So in this case, the maximum additional borrowing possible for that scheme is £125,000. Now, I say it seems to be counterintuitive, that calculation, from speaking to advisors and paraplanners over the years. It's effectively, it appears that you're deducting the borrowing twice, which seems to be incorrect. But that is the way that the calculation works, because you need to work out the net asset value first before then deducting the existing borrowing off as well. So hopefully that's been of assistance there to explain how the borrowing calculation works. If there are any suspended or gated funds that the client holds, then the SIPP or SSAS fund value includes those as long as they're in the scheme and as long as they're capable of being valued. So in some cases, and it'd be down to individual advice from the advisor to the client, it may be beneficial to make an in-specie transfer of suspended or gated funds into the SIPP or SSAS, because if they can be valued, then the value can be taken into account for the borrowing calculation. And that also applies to clients who've got arrangements where there's depressed fund values. An in-specie transfer into the scheme will avoid the need to crystallise any losses. The depressed fund value pot is just being lifted from Scheme A and dropped into Scheme B without crystallising any losses. But it does, assuming that the property can be valued, it does mean that the value of the suspended or depressed fund can be included in the borrowing calculation. But are there any challenges facing current cliently on the funding side of things? Well, there are in fact some challenges. We do appear to be encountering some difficult borrowing conditions. There are challenging conditions for borrowing currently. Banks seem less inclined to lend to SIPP and SSAS for property purchase. Now, the tenants industry or sector might have a bearing on the lending decision, and it also may be dependent on whether or not the tenant is connected with the SIPP. This will vary between lenders, and lenders do seem to view pension schemes differently from the lending to the client as an individual or for lending to their business. The pension scheme is viewed as a separate legal entity. However, depending again on the provider that you're speaking to, the borrowing facilities could be offered by a connected party. They do not have to be made available by a commercial lender. So a connected party could be the client as an individual, it could be the client's business, it could be family members. The lending to the pension scheme could be secured or unsecured, but it must be on demonstrably commercial terms. And that means obtaining evidence from a commercial lender that it would lend to the pension scheme on the same terms as the connected party is lending to it. A connected party loan might speed up the overall property purchase process, because if a commercial lender is involved, the period between initial inquiry with the lender and eventual drawdown could be a number of weeks, could be 10 weeks plus, whereas if the lender is a connected party, then it may well speed up the process. And again, as I said, it depends on the provider that you're dealing with. You need to check with your provider whether or not it will allow connected party lending to the pension scheme to assist with property purchase. So having looked at some of the background now, let's now try to bring commercial property to life through some client case studies. And we'll start with a relatively straightforward example. And this is a case study involving an outright purchase of property with cash. Now, in this case, the client had a transfer value of £95,000 from his existing pension scheme, and the client had the wherewithal to make a pension contribution of £30,000, giving a purchasing power within the scheme of £125,000. Now, the property in this case was valued at £100,000, or it was going to cost £100,000. That property didn't sit in the VAT world, so there was no VAT applicable on the purchase price. It was below the threshold for SDLT or LBTT in Scotland, and let's say the cost of acquisition amounted to around £1,500. So the overall cost of acquisition for that property was £101,500. There was £125,000 liquid cash available in the scheme, and so that enabled the outright purchase of that property with cash, no external borrowing or anything involved in here. There was more than enough cash to buy the property. In fact, there was cash left over. That cash that's left over, plus the ongoing rental income, would be available for investment in line with the advisor's recommendations. And so in this case, there was a need for initial and ongoing investment advice and involvement from the financial advisor in this SIPP property purchase, purely for cash and outright purchase. But if we move on to a more complicated situation, then here we have a situation where we're looking at using a suspended fund in the process. Now, in this case, the client had a transfer value of £700,000 available, but that did include a suspended fund that was worth £40,000. So the available liquid funds for a purchase here were £660,000. Now, in this case, the property purchase price was £800,000 and it was opted to tax, so it sat in the VAT world and it didn't qualify as a TOGC, so VAT was going to have to be payable on the purchase price. That made the overall purchase price plus associated costs just over £1 million. And so borrowing was going to be required by the pension scheme because it didn't have enough liquid cash in the scheme to enable the purchase price plus cost to be met. Well, if only the liquid cash was transferred across into the scheme of £660,000, that gives a maximum purchasing power of £990,000 because maximum borrowing on a 660 fund is £330,000. £990,000 wasn't quite enough to fund the purchase. However, if the suspended fund was transferred in specie to the pension scheme, that made the pension scheme value £700,000, as we said on the previous slide. Maximum borrowing on a £700,000 fund is £350,000, and that gave the pension scheme a maximum purchasing power of £1.05 million. But we do have to bear in mind that of that £1.05 million, £40,000 of it is illiquid funds that can't be touched. However, even allowing for that, that still gave available liquid funds of £1.01 million, which was just enough to enable that property to be funded through the pension scheme. So the purchase became possible in that instance because of the in specie transfer of a suspended fund. Let's look at another scenario then, this time involving part purchase. Here, the property value was £175,000 and it was owned by the client's own company, and it had an outstanding mortgage on it of £110,000. Now, the client had a transfer value of £148,000 to bring across to the SIPP. It had been £185,000, but this was during the pandemic, and the fund value had dropped by 20% by the time that the client came to make the purchase. So instead of being 185, the transfer value was £148,000. The client didn't want to get involved in any pension scheme borrowing here, so the available fund for the purchase was £148,000. There was no VAT applicable in this property purchase, and there was no SDLT or LBTT involved because it was below the threshold. So what the client did in this instance was use the SIPP to buy a £143,000 share of the property. Other costs of acquisition amounted to about £4,500 incidentally, and the rental value of that whole property was £14,400. So this was a part purchase that was available to the client, but as I mentioned earlier, part or joint purchase may not be possible depending on the provider that you're dealing with. So how did this look at the end of the transaction? Well, the whole property was split. 81.7% of it was owned by the pension scheme because that's what £143,000 bought. It bought an 81.7% share of the property, and the remaining 18.3% of the property was retained in the company's ownership. The pension scheme received its 81.7% share of the open market rent. That meant £11,766 rent coming into the pension scheme, and that was a yield of around 8.22% to the pension scheme. The client's company received £143,000 from the cash from the SIPP for the part purchase, and it used that £143,000 to pay off all the outstanding borrowing, leaving the property and the company debt-free. And it also left the company some much-needed liquid cash for working capital as a result of the transaction. So that's a situation where part purchase worked very well for the client. But let's then look at a business purchase itself that involved commercial property. Now, in this instance, the client had a successful orthodontist. She had a transfer value of £210,000 from a platform pension that her advisor had been looking after over the years. She didn't want to get involved in any pension scheme borrowing, so her available fund for a property purchase was £210,000. Now, she wanted to buy a dental practice for £750,000. Now, that dental practice included the dental surgery. It also included an adjacent 3-bedroom flat. It also included the goodwill and fixtures and fittings of the dental practice. And the client in this instance went to her advisor and said, I can't quite afford to buy this practice entirely through my business or using my personal wealth. I need some help with it. And is there any possible way that my pension scheme could help with this overall process? The advisor spoke to the client's accountant because they work hand in hand on these matters, and the advisor spoke to us about a potential solution here. Incidentally, there was no VAT payable on the transaction here. So what happened here was we all got our heads together and looked at a proposal here. Now, to isolate the bricks and mortar from the other assets of the business, the property was valued. And it was valued by a RICS registered valuer at £340,000. By RICS, I mean Royal Institution of Chartered Surveyors registered valuer. So the bricks and mortar was valued at £340,000. But that included a 3-bedroom flat that was adjacent to it. So we guided the advisor and accountant along the lines here, and we suggested that the valuer also value the long leasehold interest in the surgery, the commercial part of the property. And that was valued at £180,000. Now, because of the structure of that surgery and the 3-bedroom flat, the SIPP could not buy the 3-bedroom flat as well, because that was leased out to someone who had no connection with the dental surgery business. So the flat had to be legally isolated from the dental surgery itself. But in this instance, the dental surgery, the commercial part, was valued at £180,000. The client had the liquid cash in the SIPP to make that purchase. So the SIPP paid for the bricks and mortar of the commercial dental surgery, and the client's business paid the balance of £570,000, making up the overall £750,000 property purchase, sorry, the business purchase price. So using the SIPP and the client's company enabled the overall funding of the transaction, and it helped the client to dovetail her personal business and pension planning all with each other. Incidentally, it was a long leasehold interest in the dental surgery that was needed to isolate it, to legally isolate it from the 3-bedroom flat. So that's how a SIPP helped with a business purchase that wouldn't have otherwise been possible. Now let's look at a situation where a property is already held in a SIPP, but there are issues with the provider of that SIPP currently. Now here, the property was valued at around £375,000. It was in the VAT world, it was opted to tax. There was no outstanding borrowing, and there were some other assets in the SIPP as well, some platform assets and some cash. Now, the client was unhappy with the existing SIPP provider's administration and service, and it had been compulsory property management had just been forced upon the client as well, that the client wasn't happy about. The client was also unhappy that he or she couldn't any longer complete quarterly VAT returns, which they'd been doing so previously under previous practice by the provider. Now, in order to remove involvement of the current SIPP provider, the client has to transfer from it to another provider, which means that the assets have to be transferred to effect the change in legal owner. Now, it's possible to re-register platform assets from one SIPP provider to another, and it's possible to re-register bricks and mortar from one provider to another. Just a couple of pointers I would make here. You need to take into account the cost of re-registration of title of the assets to be transferred in specie, and that includes solicitors' fees and any land registry charges relating to property. SDLT or LBTT in Scotland is not payable on in-specie transfers from one register scheme to another, so that was one cost that didn't have to be worried about. And for example, Dentons approach offers flexible SIPP administration, and Dentons made sure that all necessary reporting requirements were met and other tasks undertaken as required. In order for the transfer to take place, necessary due diligence would have to take place on the property to make sure it's going to be acceptable to the new provider. And if the property has an outstanding mortgage on it, it will take longer and be more expensive to do the transfer, because the lender involved will want to potentially renegotiate the terms and will certainly want to redocument the loan, because there's a change of legal owner from one SIPP provider to another. If there are any rental arrears or other tenancy problems, there may be more problems relating to the in-specie transfer. And because in this case the property is in the VAT world, the new SIPP trustees need to register for the property for VAT, register the SIPP for VAT, and opt the property to tax before being able to accept it across. And VAT would be payable if the transaction didn't qualify as a TOGC. Ordinarily, it would qualify as a TOGC because the property will, in all likelihood, have a tenant, and that tenant is staying in situ when the property is moved across to the new provider. One last thing I'd say in relation to this slide: in-specie transfers from registered pension scheme to registered pension scheme are not the same as in-specie contributions. Dentons, in common with most SIPP and SSAS providers, does not allow in-specie contributions of assets, but in-specie transfers from one scheme to another are still allowable under HMRC rules. So for our last case study, let's look at a complicated case involving VAT. In this instance, the client had a transfer value available of £200,000. Maximum SIPP borrowing is at 50%, as we said. So the available purchasing power would have been £300,000 with maximum borrowing here. In this instance, though, the property purchase price was £670,000 plus VAT, and the VAT needed to be paid because no TOGC was available or possible in that case. The resulting stamp duty liability was £29,700, and let's say the other costs of acquisition were around £7,000. So the overall cost of acquisition of that property was £840,700. Incidentally, I should mention that even though VAT is payable on the purchase price, the pension scheme can be registered for VAT and the VAT element can be reclaimed. It can take up to 18 weeks for the VAT to come back into the pension scheme as cash. But it does, unless a TOGC applies, VAT does need to be paid up front, even though it can subsequently be reclaimed. So how did that look? We needed funds of £840,700. The available funds, or the funds available to the pension scheme, were £300,000. And so a potential solution there, once again, depending on the provider, is a joint purchase of that property. Now, that could be jointly with another pension scheme, as I mentioned earlier. It could be jointly with the client's company, it could be with other individuals personally, it could be with a combination of those. But where VAT is involved, a VAT partnership needs to be created to deal with the VAT situation. And that's something that we can assist with as well in the appropriate circumstances. So how did this look at the end of the transaction? Well, when it comes to borrowing, the pension scheme, as we know, is constrained by the maximum 50% of scheme asset value. So the maximum scheme borrowing with a £200,000 fund is £100,000. The company, however, isn't constrained by the same borrowing requirements, or limitations rather. So the company, subject to what a commercial lender is prepared to lend, could, in this case, did borrow £340,700. And those combined, the pension scheme and the company combined, enabled the property to be purchased at an overall cost of £840,700. Now, separate loans would be needed for the pension scheme and the company, obviously, and it's highly likely that the same lender would need to be involved because the lender will want to take a first legal charge over the property. And had this be, say, a couple of SIPPs jointly buying the property with the company, if both SIPPs were borrowing, there would be separate loans for each SIPP individually. So something to bear in mind here when it comes to arranging finance. So we've looked at some client-specific examples here. Let's now just have a quick look at the process to be followed where the property is being bought by or transferred in specie to a Dentons arrangement. And the first step is to complete and return Dentons commercial property questionnaire. You've got an example of it on the screen there. That's available on our website. We can also send that to your clients by DocuSign for ease of completion, signature and return. But that's the starting point for any Dentons property purchase inquiry. If the client is unable to complete all boxes on the commercial property questionnaire, the chances are that they themselves need more information before going any further with the purchase. Sometimes, for example, the VAT question on the questionnaire isn't answered, and it's because the client doesn't know the VAT status of the property, as I mentioned earlier. And as we know, that is crucial to the overall funding of the process, funding of the purchase rather. So that's the first stage, commercial property questionnaire. And in our case, Dentons will carry out the necessary due diligence and come back to you with a decision on acceptability in principle, free of charge and without obligation. And we do that for every property because, as you'll know, every property is unique. When we look at a potential timeline here of various actions, from the client's perspective, the process would be the client locates a property and completes the questionnaire for us. We do not source commercial properties for clients or for syndicates to be created. The client always comes to yourselves as advisors, power planners, and then on to Dentons with a specific property in mind. And if the property is acceptable to Dentons in principle, that's then the green light to then arrange finance if finance is going to be needed. If there's a connected party transaction involved here, for example, if the vendor is the client as an individual or the client's company, then a capital valuation would be required to confirm the open market value of the property. And similarly, if the tenant is going to be a connected party, a rental valuation would be needed. Now, it's only if there are connected party transactions that valuations are needed, although some providers may insist on valuation regardless of whether it's a connected party transaction or not. And some providers may also insist on a building survey in all cases. That just adds to the overall cost of the acquisition. Now, clients may wish to obtain surveys or valuations for their own peace of mind, but Dentons will not call for these unless they're required by HMRC. And sometimes valuations are not applicable anyway, for example, in the case of in-specie transfers from one scheme to another. And having gone through that process so far, the client knows that this is the property they want to acquire, and the funding is available, and we, as a provider, have accepted it in principle, the client selects a solicitor. From Dentons' perspective then, our role here is to consider and hopefully accept the property. If we do reject the property, there'll be a specific reason for that, and that may be the presence or danger of taxable property arising, the overall lack of commerciality, or that sort of thing. We try not to reject properties, but we sometimes have to because of the circumstances. Having accepted the property and the client wishes to proceed, in all likelihood, Dentons will carry out a desktop environmental search if the client solicitor isn't carrying that out as part of the report on title and searches. And we will produce the necessary document to document joint ownership if it's a joint ownership situation. And Dentons will liaise with the client's appointed to solicitor and give instructions. Dentons doesn't operate a panel of solicitors, so clients are free to choose any solicitor they want to handle the transaction. And as you, as advisor firms, if you have professional connections with solicitors, by all means, feel free to refer one of your professional connections. We do have a sister legal company called DPM Legal. They'd be happy to provide a fee estimate for purchases in England and Wales. And they can do so if the client ticks a box on the commercial property questionnaire. But Dentons will get the process rolling, the ball rolling with the client's chosen solicitor as early as possible in the whole process. Just some further aspects of the timelines here. Ultimately, Dentons will be party to the finance documents. We're not involved in negotiating terms with the lenders. That's the responsibility of the client. But as co-owner of the property, we need to be party to the documents. And we receive completed documents from the solicitor and request a completion statement. And we then ultimately send the completion monies and contractual paperwork to the client's solicitor. As I said, we don't negotiate terms with the lender. That's down to the client. As a result, this whole process, the solicitor's carrying out the necessary legal work in the background, and hopefully at the end of the process, the property acquisition is completed, and the client must have insurance in place at the time of completion, obviously, to ensure that the property is adequately insured from the point of initial ownership. Now, the time taken to complete this overall process will depend on the complexity of the transaction, but a minimum of 6 to 8 weeks should be allowed. And I'd also stress that there's a 30-day transfer cancellation rights period during which the property cannot be bought or committed to because of its illiquid nature. We can still get the ball rolling with the client's chosen solicitor in that 30-day period, but we won't allow exchange or completion to happen in that 30-day transfer cancellation rights period, because ultimately we could be asked to send the transfer monies back to the transferring scheme, and we can't do that, obviously, if they've been allowed to be tied up in bricks and mortar. The property will be insured under Dentons block insurance policy unless there are exceptional circumstances. So they're not to be, for example, if it's a long leasehold interest or it's a jointly owned property where the other party is insured, those sorts of things. But Dentons ultimately allows clients to self-manage the property, and by that I mean calculation, invoicing, collection and review of rent, and to complete quarterly VAT returns and things if that's what the clients wish to do, although we can do that if they'd like us to. Now, just a quick word on connected party transactions. As I've said, SIPP can buy, sell or lease property to a connected party. That could be the member's company or the member's family. But connected party transactions need to be supported by a registered valuer's valuation. And if the client is an individual or the client's company is the vendor, that releases cash to them. And it is a nice way of dovetailing the client's own financial planning with and the retirement planning with that of their business. It's a popular course of action in SIPP and SSAS with Dentons. One thing I would point out at this stage, though, is that despite some press reports to the contrary, stamp duty or LBTT in Scotland is payable on connected party transactions. You may have read something recently that suggests that that isn't actually the case, but as far as we're concerned, the SDLT and LBTT are payable on connected party transactions. So we've now had a good look under the bonnet at property ownership and SaaS. Let's revisit the learning objectives as promised. And hopefully we've covered those off to a greater or lesser extent for you. Now, as I mentioned, if you wouldn't mind, we'd like to conduct an advisor poll with you. And the question is, do you think that your firm will become more involved in commercial property SIPPs and SSAS in the next 12 months as lockdown restrictions are eased or removed? So if I can ask my colleague Andy to bring the poll up on the screen. Andy, if you wouldn't mind, please. So you see the questions there. Do you think your firm will become more involved? Yes, no, or unsure? We'll just give you a moment or two there to complete the voting. Good to see a number of people voting there. Thank you very much. I think that's probably long enough now there, Andy. So if you will end the polling, that'd be great. And if you could share the results. Well, that's positive from our perspective, that the majority will be more likely to become involved in commercial property. That's great news. If you're unsure, then potentially that's something that we can help you with as a provider, given our specialisation in commercial property. So thank you very much for voting there for us. I will now remove those results from the screen. So yeah, thanks again for voting there. Just a quick word before we move on to the Q&A. I'd just like to make you aware, in case you're not aware of this already, that we have partnered with IntelliFlow's Intelligent Office, and that enables you now real-time daily asset valuations for Dentons SIPP clients that you have. We feed automatically now into Intelligent Office, and that may help you with building historic valuation records for your clients and help with your overall planning and reporting. The Dentons app is available. It's free to download in the iOS store. So if you do have Dentons SIPP clients and you use Intelligent Office, please do take advantage of that facility there. It should make your life a bit more straightforward in relation to reporting for your clients and manual re-entry. I mentioned I would introduce my colleagues to you earlier on the webinar. These are my colleagues around the country. We have national coverage, as you'll see from the screen there. I'll leave the contact details on the screen for a second or two. If you don't already know who your Dentons point of contact is, hopefully you can make contact with them now as a result of the webinar and the details there. Now, can I just ask Andy to come on audio, please? Andy, did we have any questions come up through the Q&A at all?
Hi, Steve. Yes, we did have two questions, actually. So the first would be, would Dentons accept a wind farm investment into a SIPP/SSAS?
Right, that's a good one. And it is quite common, actually. I was on holiday staycation last week, and driving up and down the motorways, the number of wind turbines across the country is phenomenal. So it is something that does come up quite regularly with us. Now, believe it or not, despite their size, a wind turbine is classed by HMRC as tangible movable property. That is something you can touch and move. And I suppose with a big enough crane and a big enough truck, you can remove it from site and transport it elsewhere. So the wind turbine itself is tangible movable property. And if it was owned directly by the pension scheme, SIPP or SSAS, it would be taxable property. So we wouldn't allow the acquisition or the purchase of the wind turbine itself. However, the land that the wind turbine sits on is not tangible movable property. And so we have had some live cases of situations where we've allowed a SIPP or SSAS client of ours to own the land that the wind turbine sits on. That produces, in a lot of cases, in my experience, a very healthy rental yield for the pension scheme. So the pension scheme gets a good rental yield from the land that the wind turbine sits on, and the operator of the wind turbine then operates the wind turbine and sells the energy on and makes its money that way. If the pension scheme had been able to own the wind turbine as well, and it was generating energy and being paid for that energy, that would effectively be trading, so which would be taxable. So owning the land that a wind turbine sits on is fine, get the good rental yield from it. Owning the wind turbine itself is a problem, and we wouldn't allow that to happen. What was the other one, Andy, please, if you don't mind?
The other question we had was, would there potentially be any gains liable on the property purchase from company by SIPP?
Potentially, yes, it would, because if the property is grown in value, and if ultimately there is a capital gain there, once you take into account the various capital allowances and things and expenditure that have been spent on the property over the years, This would be for the client's accountant, obviously, to answer. But if there's been a gain on that property within the company's possession that would be subject to a capital gains or a corporation tax liability, then yes, it's a disposal of an asset by the company for capital gains or corporation tax purposes, and so tax would be payable. The fact that it's being sold to a willing buyer, the pension scheme, makes no difference to the taxation side of it. It just happens to be a disposal of a company-owned asset, and it's the same taxation rules that would apply whether it's a connected buyer or an unconnected buyer. If it's subject to corporation tax, capital gains tax, then it's subject to it, and that would have to be paid. But at least that has then capped the future capital gains or corporation tax liability going forward into the future, because now that it's in the pension scheme's ownership, obviously, as we said earlier, there's no capital gains tax on eventual disposal of the property. So those are the only two questions, Andy, is that correct?
That's all the questions we've got. Okay,
Andy, thanks. There was one other question that I thought may come up, and it does come up quite often. We're often asked whether a property is likely to be in the VAT world, subject to VAT, and there's no straightforward answer to that. You could have two properties almost identical, adjacent to each other. One might be in the VAT world and the other one may not be. And that may be down to, for example, some refurbishment work that happened on one property that didn't to the other, and the developer wanted to register the property for VAT so that the VAT on the refurbishment works could be reclaimed. So there is no hard and fast answer to the VAT status of a property. And if you are speaking to any clients about property purchase, one thing, as I said earlier, I would stress to the client is if the vendor or the vendor's agent is not making the VAT status of the property clear early on in the process, you have to, well, the client has to be firm on that. It has to be known, because one way or another, the vendor should know whether that property is opted to tax currently, and they should be making that information available to the client, because it's crucial to the funding, as I said. Well, if those are all the questions, then thank you for the questions, and thanks again for taking part in the poll. I'd just like to conclude by saying thanks very much once again for joining us. If there's anything else you'd like us to cover, or you've got any client-specific inquiries, please do get in touch with your dedicated point of contact from Dentons, whose details were on the screen there. CPD certificates will follow in due course from your dedicated point of contact at Dentons. The session's been recorded, so if you think any of your colleagues would like to listen to it at some point, that'll be available on our website very soon. Please do try to stay safe as ever. Thanks again, and good morning.